The hidden cost of saving the system. Every rescue has a price. It just isn't paid all at once. And it's rarely paid by the same people. To understand the hidden cost of saving the system, we have to look beyond the moment of rescue itself. When a crisis hits, the focus is narrow. Stop the collapse. Restore confidence. Prevent contagion. Those goals dominate every decision. But the consequences of those decisions unfold slowly, long after headlines fade. Today, the system appears resilient. Crises are contained faster. Failures are absorbed. Markets recover with surprising speed. But beneath that stability lies a series of trade-offs that rarely enter public debate. Each rescue shifts incentives. Each intervention rewrites expectations. And each success quietly changes behavior. At first, saving the system feels like an obvious good. Jobs are protected. Credit continues to flow. Panic is avoided. The damage that didn't happen becomes the justification. But what didn't happen is hard to measure. What did change is easier to overlook. Banks learn which risks are survivable. Markets learn which shocks trigger support. Investors learn when fear will be answered with reassurance. These lessons shape decisions long before the next crisis appears. Risk does not disappear. It relocates. The earliest signs of cost are subtle. Leverage inches higher. Complexity increases. Short-term gains feel safer than they should. The system looks calm, but only because pressure is being redistributed, not eliminated. Saving the system solves the immediate problem, but it also creates a longer question. Who carries the weight of stability over time? And how much invisible strain can a system absorb before the cost becomes unavoidable? Those questions sit quietly in the background, waiting for the next test. As rescues accumulate, their costs compound in ways that are difficult to trace. Each intervention alters incentives slightly. Over time, those small shifts reshape behavior across the system. What feels negligible in isolation becomes significant in aggregate. One cost appears in risk tolerance. When collapse is consistently prevented, caution loses urgency. Decisions are made with the assumption that extreme outcomes will be softened. This does not mean recklessness becomes deliberate. It means boundaries feel more flexible. Margins feel wider. Another cost emerges in market signals. Prices no longer reflect pure risk. They reflect expected support. Investors price assets not only on fundamentals, but on the likelihood of intervention. This blurs information that markets rely on to allocate capital efficiently. There is also a fiscal dimension. Even when rescues are repaid or profitable on paper, they mobilize public capacity. Guarantees expose taxpayers indirectly. Balance sheets expand. Future policy space narrows. The system survives today by borrowing from tomorrow's flexibility. These costs are rarely visible during calm periods. They surface gradually as distortions, asset bubbles, concentration, dependence on scale. Each one traces back to a system optimized for survival, not balance. Attempts to offset these effects often lag. Regulations tighten after behavior has already adapted. Rules respond to the last crisis, not the next one. The system stays ahead by learning faster than oversight evolves. This creates an uneven cycle. Rescue, adaptation, regulation, circumvention. Stability holds, but tension builds beneath it. The cost of saving the system is not a single bill. It is a growing imbalance that waits for a moment to matter. The conflict sharpens when these hidden costs begin influencing outcomes beyond finance. Economic inequality widens. Asset ownership concentrates. Those positioned closest to markets benefit most from stability. Those farther away experience it indirectly, if at all. This divergence is not accidental. When systems are stabilized through financial channels, benefits flow first to financial participants. Asset prices recover. Credit resumes. Wealth tied to markets rebounds quickly. Wages and employment follow more slowly. Rescues also shape competition. Large institutions absorb shocks more easily. Smaller players face tighter conditions. Consolidation accelerates. Scale becomes protection. Over time, the system favors those already equipped to survive turbulence. Public trust erodes quietly, not through panic, but through resignation. People stop expecting fairness from interventions. They expect functionality. As long as collapse is avoided, the system is tolerated, even if outcomes feel skewed. This tolerance masks a deeper vulnerability. Stability, without legitimacy, relies on momentum. It holds as long as results appear acceptable. But when pressures accumulate, patience thins. Questions once postponed return with force. Inside the system, awareness grows. Policymakers acknowledge trade-offs, but struggle to redesign structures without risking instability. The tools that preserve calm are the same tools that generate imbalance. Removing them threatens disruption. Keeping them entrenches costs. The buildup reaches its peak when the system's resilience becomes its weakness. When survival is guaranteed, adaptation slows. Innovation shifts toward navigating protections rather than improving fundamentals. At that point, the hidden cost of saving the system is no longer hidden. It becomes a central challenge, and resolving it requires choices as difficult as those made during any crisis. The climax arrives with a realization rather than collapse. The realization that saving the system has kept alive, but not necessarily healthy. Stability has been purchased through accumulation, not correction. Rescue succeeded in preventing immediate damage. They bought time. But time was not always used to address root causes. Instead, it allowed pressures to shift, grow, and settle elsewhere. The system moved forward carrying unresolved weight. The resolution is complex. There is no clear moment when the cost can be repaid. It is embedded in structure, behavior, and expectation. The system now depends on its own interventions. Stability requires constant readiness. Yet awareness changes the conversation. Recognizing the hidden cost forces a question about balance. How much protection is enough? How much distortion is acceptable? These are not technical questions alone. They are societal choices. Today, American banking operates with this tension fully in place, resilient, adaptive, and burdened by its own success. The system stands not because it is simple, but because it is supported. What comes next depends on whether future stability is built through correction or continued rescue. The cost will be paid either way. The only uncertainty is how and by whom. The hidden cost also includes something harder to quantify than leverage or asset prices. It includes erosion of the experience of failure itself. Failure, at appropriate scale, is information. It tells the system which strategies do not work, which institutions are not as sound as they appeared, which risks were mispriced, which assumptions were wrong. When failure is systematically prevented, that information is not generated, or rather, it is generated, but not transmitted. It accumulates inside institutions, inside balance sheets, inside the unexamined assumptions of people who have never personally experienced significant loss. An unexperienced loss is the most dangerous kind, because it produces confidence that has not been tested, strategies that have not been stress tested by reality. Risk tolerance is calibrated to a world in which the system always catches you before you hit the ground. The people making decisions inside large institutions today have, in many cases, operated their entire careers inside a system that has never allowed failure to propagate fully. They are skilled at navigating the system as it is. They have limited direct experience of what happens when the system breaks. That is not an indictment. It is a consequence of exactly the stability the system worked so hard to achieve. And it means that the hidden cost of saving the system includes the gradual replacement of hard-won institutional memory with something softer, the assumption that the system will perform as it has always performed, right up until it doesn't, which, in the absence of corrective failure, arrives without warning, precisely because no one inside the system has a clear memory of what the warning looks like. That warning is always present, in the metrics, in the signals, in the subtle accumulation of risk that careful observers can see forming. But without the emotional memory of what it felt like last time, the warning is harder to act on. It is easier to explain away, easier to defer, easier to absorb into the narrative that this time is different, or that the system has learned, or that the tools are better, all of which may be true, and none of which guarantees that the hidden cost is not, even now, quietly accumulating again, waiting, as it always does, for the moment when the weight, finally exceeds what the structure was built to hold. The hidden